Hi, Namaskaram. I want to share my thoughts on mutual funds. Mutual funds or investment schemes very much similar to FD and RDs of banks. Mutual funds work by collecting deposits, very similar to what banks do. They Mutual funds pool money from the investors and invest that money in stocks and in equities and debt instruments. Debt instruments would include your corporate bonds and government bonds. Debt instruments are considered as safe as your FDs and RDs in terms of generating reasonable returns. Um, there is very little to choose in business models between banks and mutual funds. There is a popular notion that mutual funds carry a lot of risk. I think there are other theories about it. When you see the business model, there is very little to choose between mutual funds and banks. The end use of the money is invested in business. Banks collect money from the general public in the form of FDs and RDs and invest that money in business units in the form of loans. Whereas mutual funds, thanks. Mutual funds do the same thing. They invest in equities and debt instruments. So there's very little to choose between mutual funds and banks in terms of business model. But there is a risk element. One of the reasons behind for this particular notion, that is prevalent in market, in the mindsets of the people. Only reason I could think is because of mutual funds focus on equities. See, when I carry equities carry a equity investment in equities carry a bit of carry a element of speculation, as markets may not in all cases reflect the performance of the company, may not reflect the actual performance of the company. You will have shares that is trading 3 or 4 times its book value or its true value. So I think mutual funds perception of risk comes is generated comes from this speculative element in stock market. It is not applicable for all stocks or for all companies, but it is also a factor that one cannot ignore because it's a hard-earned money, and so one should factor in this speculative element that is present in stock market. Though you have statistical methods, everything, but increase or decrease in price, sometimes determined by sentiments and other irrational factors, market forces. So this is one of the reasons behind the risk, behind the popular notion that mutual funds investments are riskier. On the other side, it has got huge potential of generating good returns. There are stocks, that that trade that trade at the right price. So you should look out for funds that invest on that negates the speculative element and works. Performs. And his performance is based on his fundamentals. So there are funds that there are there are mutual funds that have done extremely well. Uh, Funds that focus on large cap companies and debt instruments. Um, there are hybrid funds, which is a combination of debt and equities. I mean, you'll have 60% of the funds invested in equities, 40% in debts, to mitigate them, to reduce the level of risk that is present in equities. Let me give an analogy. I'll take a cricket match, a 50 overs match. First 40 overs, when people play normal cricket in strokes, score runs. Last 10 overs, they play aggressive. They expect aggressive returns. I mean, the same way, debt funds, investing more in debt funds, hybrid funds, which has a high component of debt and a low component of equities. Um, 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 is similar to the cricket match. Analogy. Debt fund. One could look at it. One could compare it with the first 40 overs of the cricket match. It generates good stable returns, launches a platform. Area of it addresses your insecurities. Next thing you want to express yourself, you can go for equities. The last 10 overs. In case you fail, you have this debt fund. You have something to fall back, some cushion to fall back in terms of in the event of a loss. So this is the funda behind hybrid funds, which is very popular in the market. It does not mean that equities funds are not do not. The equity funds are not profit generating investment schemes. Equity funds carry a lot. Let me say, let us accept. It carries a bit of speculative element. At the same time, it can generate high returns. So, choosing a fund. So you should look at funds which invest on equities that allows less room for speculation. There's room for speculation, though it is in the hands of the market. People who trade, sentiments and market, external factors. But you should have a fair idea. On the difference between true value on the market value. You should be able to identify the right price. The right price of the stock, so that you will know that when the stock is trading is trading at a value very higher. At a higher value, you know that stock price will come down one day. So it's better to seek a financial consultant before investing in equities. To the one thing, most important factor in choosing the fund. On choosing the fund is the experience of the fund manager. You should choose a fund with the experienced fund manager who has had success in the past. In the past. Second thing, the portfolio. You should have the right mix of equities and debt. This will not only elevate the risk component, at the same time generate good long-term returns. So these are the factors that one should keep in mind before choosing the fund. There are other statistical measures which I'll be discussing in the next YouTube session, like alpha, R-square test, Sharpe's ratio. But the most fundamental thing in determining the success of a mutual fund is investing by diversifying the risk. That is, You should choose a fund with the right mix of equity and debt. And fund manager, second, experience of fund manager. So these are two important things, very fundamental. To one's decision, one's decision to choose a fund. So I want to keep it short. Um, uh, so, Mutual funds is not a bad option, and compared with FD and RD. Let me explain how to invest in mutual funds. There are two schemes. One is SIP, systematic investment plan, very similar to RD, recurring deposit, where you contribute every month. With SIP, you contribute every month to the fund. You buy in NAV units, mutual fund units. The advantage of SIP is you could buy units at a lower price and sell at a higher price. That is, let me give an example. I could buy 1000 units at the rate of 10 rupees per unit and sell at 12 rupees the next month. The advantage here is I can plan my investment. Investment is a dynamic process. I could roll back my investment if there is a dip on the there is a decrease in the unit value. So this is very open. My SIP offers provides enough room for one to plan their investments. Other advantage is SIP. SIP allows you to buy units at a lower price and sell at a higher price. So this rule is known as rupee cost averaging, and one of the reasons began huge profit made in SIP. Third thing is rule of compounding, very similar to compound interest. So these two rules make SIP a good investment choice. Second way of investing in mutual fund is SWP. This is a systematic withdrawal plan, wherein you can buy, you invest lump sum and buy a lot of units and redeem those units every month, every quarterly or every yearly to pay yourself a fixed income. This is also known as fixed income, similar to pension plan. The same, it has got a lot of advantages. And it's got a lot of advantages, similar to SIP. It allows you to, again, same old principles, rupee cost of averaging and principle of compounding. So there's a flip side to it. Again, flip side. It's about mutual fund investment is like seeing half glass full and half glass empty. There are negatives. It can go down, but everything depends on your analysis of the fund. You should take time in analyzing the fund's portfolio. That is very, very crucial to be mutual fund success. Nothing comes easy in life. I think mutual fund is a good investment opportunity if you have a risk appetite. Thank you. Nandri, Vanakkam.